Hey YouTube, this is Zach with Achilles Financial, and today we're going to be talking about STEM as they announced their Q4 earnings today. This is a video where we are going to cover a lot of information and we'll be going to a lot of different screens, so please stick with me. The first thing that we're going to talk about is the actual share price. Keep in mind that clean energy in general had a very rough day today. You can see that by other similar companies such as Fluence Energy, who was down both before and after hours today for a cumulative north of 8% down. Another company that we like to talk about here on the channel is Tesla. You can see Tesla was also down by more than 6%, with some of that coming after hours. So the reason that I highlight that is overall we are seeing a lot of tech get hit today, and in particular clean energy. That being said, we also saw pretty dismal earnings from STEM. It's important to note that the volume today was higher than average. Remember, STEM tends to be around that 3 million, and now they're nearly double that here with this about 5.5 million shares traded today. It's important to note as we're evaluating the company that something that I would call out is they are still about 10% higher than the $20 a share that was around when the company had the short report released by Blue Orca Capital released against them. So why is the stock down? So we've now moved on to the earnings report, and this is on TD Ameritrade's website. You can see STEM that they were originally projected to have about 20 cents a share. Most of the estimates I saw said 18 cents a share negative for earnings per share, and they actually came in around 22.23. So if we look at these news sites over here on the left-hand side, you're going to see that they had a miss in two separate instances. The first component is that the analyst consensus by way of revenue was 166 million, and they were down to 155 million, which again was a miss. You can also see that they had losses of that 23 cents a share compared to the estimates of 20 cents a share. Again, I saw most of those were around 18 cents a share. Now, I don't want to take away from the fact that the growth here is staggering. It is super impressive. However, when you're originally forecasting quite a bit more, and they did come out and say we're expecting to be on the lower end of the forecast, I did not necessarily think that they meant the very bottom. So what this puts us at is an interesting situation in terms of how do we evaluate the company on a go-forward basis. So now I am in the earnings deck. It is available on their website. I'll also have a link to it in the description down below. And for those of you who joined the earnings call with me today and we watched that live, we were almost there for about an hour and a half from start to finish. So you're probably used to looking at the slide deck, but there's a ton of information in here. And the items that I want to highlight is we can't take away from the fact that the company is growing in a massive way. This revenue is up nearly 200% year over year. That is, once again, a company record. GAAP and non-GAAP gross margins are increasing. And this is the first time that they had more than $1 billion in total bookings in a single year. So that has led to nearly $1 billion in that contracted backlog. And right now their CAR revenue, contracted annual recurring revenue, is about 65 million. Now, while the company is still not positive on a adjusted EBITDA basis, or what's even more important, on a net income basis, they did have a similar loss to what they produced in 2021, despite the fact that the company had a lot more revenue and they continue to perform very, very well. Now, something that the CEO, John Carrington, mentioned multiple times on the call is that they are indeed well positioned to achieve EBITDA positivity in the second half of 2023, and they're taking a lot of components or a lot of points to make sure that that is going to happen. One of those, you can see some of that operating leverage, that they're continuing to spend in an appropriate way, and they're also looking to expand into other service areas. So one thing I would call out is this service revenue growth continues to explode upwards, as well as they're going into other product lines, such as the relationships, which are entirely going to be software driven with companies such as ChargePoint. So let's talk about some of the different components of what they're looking to do on a go-forward basis. Again, I'm not going to go slide by slide for these, although that's definitely potentially worthwhile. Something that I would call out is they are looking to, or have already begun to, expand into this PJM group. So some of their backlog is a different approach, some of their backlog is this PJM group. It is a group of states in the middle of the United States, and it is a larger overall power grid than the state of California by nearly a threefold size. So one of the things that we're looking to do, or they are planning on doing, is becoming a part of or a piece of this group so that they can continue to offer their software services. The idea here is that it is going to be heavy on the Athena fees. So this is one area that it is not necessarily a new product offering, but a new product expansion that was called out. And I do think that this is an area showcasing the potential for the company. In addition to that, I want to call out that we also had some incredible progress by way of total revenue in some of the metrics that you're seeing here. And that we do see that 8% gross GAAP margin. However, they were forecasting 13% they were forecasting 20% at the beginning of the year, and the full year margins are around 13% on a adjusted basis. So those are going to be some of those numbers that you're seeing here, and that 13% versus the original 20. A lot of that is driven by a hardware mix as opposed to the software mix that we were originally expecting. Again, this is something that management mentioned. However, it is still somewhat concerning that it was that large of a miss. So they're talking about how they can improve that EBITDA margin going forward. And the reason for that is because, again, there has to be some clear line of sight to profitability on a go-forward basis. One of the concerns I have is we just had a massive quarter for revenue. So if I go back up above, you can see that we had, on a 12-month basis, $363 million by way of total full year revenue, with a large increase up to $156 million in just 3 months. However, despite that, if we come down below, you can see 3Q22 to 4Q 2022. Despite the fact that we had $150 million in revenue that was delivered, the overall contractual annual recurring revenue component only went up by $4 million. That is an incredibly low conversion rate. And if this is indeed Athena software that we were expecting to see in the majority of that product, I would expect to see this number be going up quite a bit higher than that. So as we're evaluating this, I just want to call that out in terms of what does this mean on a go-forward basis. In 2023, the company is once again expecting a significant increase in overall revenue. This is to the tune of about 50% growth in here. Once again, backloading the year. I'm a little surprised because I was anticipating seeing a large increase in overall revenue in either Q1 or Q2 from the project that pushed in Q4. And I don't see that in the representation here. Out of this $550 million on the low end, and I'm looking at this car revenue number that they have down below because I do think that the recurring component is super attractive. Out of this $550 million, if we're at $65 million right now, that means on the low end, we would only expect to contribute about $15 million of this to get to that number. That means that this is by and large going to be heavy hardware or one-time services as opposed to actual software revenue. The reason why I keep bringing that up is because this is a question that the short report highlighted by Blue Orca Capital. And I think that it's an important question, and from the way that management continued to skirt around that question in a number of the sessions or the Q&A components that the analysts were asking questions, I thought it was important to note that overall we weren't getting a firm answer on what percentage of these sales were software versus traditional services. And because of that, and because of the guidance that's listed here between these two numbers, I'm continuing to expect that we may continue to see a lot more hardware sales, which is essentially meaning that they are more of an installation company and not necessarily an AI hardware or AI software company, which has a lot of concerns for me. Now, something that I would call out that covers some of this and does make a change here is that we still have the capability to view the company overall as a very high growth, clean energy player. That being said, the company currently trades at about 3 times sales for the 2023 metric. Their competitor Fluence currently trades on a 3x basis for their 2022 sales. So STEM currently is trading at a 6x price to sales. And so if they were looking at 2023 year-end numbers and they're in this range, that means the share price would essentially be half of what they're at right now, or not quite half. I don't want to scare anyone. About 70% of where they're at right now, which means that their current share price would be equal to this on a 3x basis from a more of a hardware perspective, which I think that Fluence is in that space. So all that being said, does this mean that I am any less bullish on STEM? And I'd have to say yes. Does that mean that I don't think that we can make money? I don't think that that is the case. This is a stock that I think we're going to continue to have the opportunity to sell a lot of covered calls and continue to have a position. But until we see a clear line of sight for that software really coming online in a material way, I think that that's going to be how the company has to be evaluated on a go-forward basis. So these are the 2023 guidance numbers. Let's take a look at the actual 8K, which is the quarterly filing with the financials. So this is the income statement. I'm actually in their 8K right now, which can be found on the SEC website. I'm using Edgar. What I can showcase here is that in terms of revenue, this is where the Athena revenue would be housed, services and other revenue. You can see that on a hardware revenue basis, $310 million is how much was recognized in 2022. And the cost of that is that $286 million, not exactly a crazy margin. Where we would expect to see a large margin is in the services and other revenue number you see here, and the cost of services and other revenue down below. It's important to note that from these two revenue numbers, currently also Energy, who was purchased last year, is contributing about a 60% margin on their software. STEM continues to be more of the hardware supplier, and you're seeing that reflected in these calculations right here. It's important to note that over the course of this year, there was heavy expenses. And the focus that I want to call out here is that the company, once again, after all their net losses, totaled $124 million. It's important to note as we're evaluating the calculation right there that while we are improving on a net per loss share basis, I would like this to be net profitable in the original timeline of that 2024 number. It's got to be profitable in the second half of 2023. And the reason for that is you can see these statements of cash flows on this screen right here. And while the company continues to remain in a comfortable position by way of cash here, you can see that the overall cash position down here dropped by $106 million. The reason I call that out is because right now in the balance sheet, you can see that current assets, we can calculate cash and cash equivalents as well as short-term investments. We're currently sitting at around $224 million. While that's important to note, I would highlight that they continue to showcase accounts payables down below of about $83 million. So that means the company has to continue driving that sales force to continue to bring new cash into the company so that they are not forced to do another capital raise or to bring on debt in another fashion. I think that the management team is in a comfortable position to be able to manage this, but you can't have another year where you're losing $100 million. So while the overall tone of this video is a little bit more somber than prior videos, I want to highlight that the company is continuing to grow. They have a clear path to profitability. And while we do have some red flags, I don't think that there's anything that is surprising to me within those red flags right now. But that doesn't mean that I'm going to continue to be purchasing shares at this point. However, I will maintain my sizable position, and I will continue to sell covered calls. So overall, I'll follow up with a series of tweets on this information. But let me know in the comment section down below your thoughts on the overall earnings report and any additional context or conversations you would like to have. I would also recommend you watch the live video, which is available here on the channel, or you can go to STEM's website, and in particular, listen to the Q&A by the analyst there at the end, because that was probably the best Q&A that we've had on a STEM webinar. It was refreshing to hear management have to really stretch some of those mental muscles, as well as we had a number of new analysts that were on the call that seemed to really know their stuff. And I think that as STEM continues to gain analyst coverage, you're going to continue to have them be asked hard questions, which hopefully will encourage the company to continue to perform at a higher level. This is probably not going to be the last earnings review, but this is the one that I'm making currently the evening of earnings, and it should be coming up Friday, February 17th. So if you've made it this far, appreciate you watching. Looking forward to talking through this and watching or working through what this could mean for the company on a go-forward basis. Thanks. Talk to you later.